Imagine this, you're a regular person living somewhere in Europe and somebody tells you, hey, you can become the owner of a big company, maybe even a millionaire. Sounds exciting, right? And it's true, people in Europe and other developed countries around the world can buy tiny pieces of big companies and potentially make lots of money. This magical place is called the stock exchange. But let me show you how this isn't just a dream, but reality. Take Warren Buffett, for example. He's one of the most famous and richest investors in history. Back in 1965, if you had invested 10,000 euros in his company, that would be worth right now 60 million. Or look at Sweden's Mycronic AB, a company that designs production equipment for electronics. Over the past decade, its stock has grown by incredible 3,392%. Turning small investments into huge money. But here's the thing, when you think about investing, what comes to mind? Apple, Tesla, Bitcoin, huge American companies. That's what most people think about. But what about small countries like Estonia, Latvia, Lithuania, the Baltic countries? These countries have also billion-dollar businesses too. Wouldn't it be amazing to invest in your local countries if you're from Europe instead of sending your money away? But here's one problem specifically with the Baltic stock exchange. To say it softly, it's kinda dead. So let's start with some interesting examples. In Latvia, there's a company listed since 1997 called Sigulda Stock Breeding and Artificial Insemination Station. You heard that right. They literally sell high-quality bull semen. And guess what? Their share price has increased by more than 1,000%. That's right, bull semen is literally worth gold in Latvia. But how does this translate into real numbers? In 2023, the company reported a net turnover of 1.5 million, with 63.8% of the revenue from the sales of breeding bull semen alone. That's quite the story in Latvia. Let's look at Estonia. Here in our neighboring country, there is a company called TKM Gruppe, owner of the Silver grocery stores. Their shares have exploded by over 3,000% since their listing on the Nasdaq Tallinn Stock Exchange in 1996. And in Lithuania, Grigeo AB, a toilet paper manufacturer, has seen its stock price skyrocket by 7,000% since its initial public offering in 1994. By the way, that's when I was born. To put this into perspective, if you had invested in this Lithuanian company, let's say 10,000 euros, that investment would be worth 710,000 euros. The funny joke, I guess, is that toilet paper is turning people into millionaires, right? Who would have thought? These numbers are as impressive as Tesla or Apple, but here's the catch. These success stories are rare exceptions. For years now, the Baltic Stock Exchange has looked like a forgotten island in an ocean full of billions of euros just floating past them. Let me share one really successful example of the Baltic Stock Exchange. The company is, as we mentioned before, is the TKM Group, one of the Estonia's largest retail companies. They employ over 4.7 thousand people in 2024. Even though there was some economic struggles and global conflicts, the company made 944 million in revenue and 27.5 million in profit, making them one of the most successful Baltic stock market companies. Let's look at some history. So back in 1990s, after regaining independence, things looked really promising. Companies were privatized and listed on exchanges. Excitement was everywhere. But then it came to 2008, the global financial crisis. That's where everything started to break. Latvia got hit the hardest from the Baltic countries. There was like a real estate bubble where banks were giving easy loans to everybody and brokers were leaving the stock exchange to chase, like easy money in real estate. The Riga Stock Exchange once reached 13% of its GDP, but today it's at a shockingly European low number, which is just 1.4% of its GDP. The number of listed companies dropped from 60 to just 8 today. There was even a period lasting 13 years where no new companies joined the market at all. Lithuania isn't much better off. There used to be a time where the stock market was 1/3 of the whole economy of Lithuania, but now it's just 6% and only 23 companies are listed. Estonia is slightly better. Its market capitalization is still around 13% of its GDP, but nowhere near as it peaked from years ago. So what's really going on here? The Baltic stock market faces 3 challenges: past mistakes, systematic problems, and cultural factors. I know it sounds complicated, so let me explain. First, trust issues. Latvia has faced big scandals that have deeply affected public's trust in the financial system. One of the best examples to put this into perspective is the collapse of the ABLV bank in 2018. It happened when this bank was accused by the US authorities of laundering 2.1 billion euros in criminal assets. This scandal exposed huge weaknesses and raised doubts about Latvian banks. Between 2006 and 2017, the US banks flagged 7.6 billion in uncertain transactions, calling Latvia as a high-risk country for money laundering. These problems have left investors skeptical about investing in these markets. Second one is bad decisions. Governments across Baltics have made critical mistakes that stiffened market development. In Latvia, pension funds couldn't invest in stocks for many years. This decision made people lose billions in possible profits. For example, during the 2008 financial crisis, Latvia cut how much people paid into pension funds from 8% to 2%. This kept people's money in low return investments like government bonds instead of letting the money make more money with stocks. Even now, Latvia is behind Estonia and Lithuania when it comes to putting state-owned companies, SCOs for short, on the stock exchange. These SCOs are government-owned companies that have publicly traded shares, while this is accounting for 36% of Lithuania's market capitalization and 38% of Estonia's. Latvia has no SOEs listed at all. In Latvia, for example, companies like Latvenergo and Latvian Railway can't join the stock exchange because of rules and disagreements in politics. This lack of participation from major players limits market size and liquidity in a massive way. And third, the last thing, high fees and poor infrastructure. Baltic stock markets have problems because it's too expensive to trade and not many people can easily invest. For example, pension fund managers take up to 2% of fees each year from the investment plans with stocks, which is high cost compared to cheaper choices in other places. Also, companies that want to join the Baltic stock market have to pay much higher fees, which sometimes are 30% more than other European countries if they want to join the stock exchange in their country. Pension funds could help bring life back to the Baltic stock market, but they play it very safe. In Estonia, Latvia, and Lithuania, pension funds manage over 1.8 billion euros. However, they don't take many risks. In Latvia, only 13.25% of pension funds money is invested in local stocks. So more than 86% is invested outside of the country. But it used to be around 40% in 2015 for Latvia specifically. Some funds like Luminor have started putting more money into local businesses. For example, they invested 18.3 million in ENVL Private Equity Fund 2, which is a fund that invests in growing businesses in the Baltics, and 13.5 million in Raft Capital Baltic Equity Fund. Both of these investments support small and growing companies in the Baltics, but they're still a small part of the total fund. But the situation today that the Baltic exchanges in Tallinn, Riga, and Vilnius are part of Nasdaq, the same giant group that runs America's famous stock market. They got into a global system and they're slowly trying to get back on their feet. And here's something amazing. Regular families across Estonia, Latvia, and Lithuania have more than 30 billion just sitting in their bank accounts. Yes, you heard that right. In recent years, new companies have begun listing again, some even worth billions. For example, Vilnius and Tallinn each have companies valued at over 1 billion euros. Riga recently welcomed a new company onto its exchange, a company called Kalve Coffee, showing their still life and ambition here. But there are still big trust issues, high fees, old systems, and lack of financial knowledge in the society, and no strong reason for state-owned companies to join the stock market. Latvia, for example, faces challenges with public trust because of past scandals and mistakes, like stopping pension funds from investing in stocks for many years. Maybe it's time also for the Baltics to learn from Sweden, the superstar of European stock markets, by the way. Sweden attracted over 500 new companies in just 10 years by creating a system where everyone from regular people to pension funds that can easily invest in their local businesses. People invest locally in Sweden instead of sending the money abroad, and they find investing simple. As Tony Elofsson from Carnegie Group, who is a seasoned Swedish investor and a financial expert, says, why cross the river to get water? Why send your money overseas when you have great companies right here at home? The Baltic countries have everything they need, promising local businesses that want to grow, billions of euros waiting in people's savings account, and a society that's slowly becoming more interested in investing. So here's the real question we all need to think about. Can the Baltic Stock Exchange wake up again and become Europe's next big investing success story? Or will they remain a sleepy island forgotten by investors? And here's something I want you to answer down below in the comments. If you had 10,000 euros right now, would you invest it locally in the Baltic countries, or would you still send it overseas, and why? Stay sharp and let's talk about it.